Hello, it's Bob Steele. In this lecture, we will take a look at Chapter 10, Plant Asset, Natural Resources, and Intangibles. Notice that we will be drilling down on basically specific accounts at this point. So chapters 1 through 4 in this book will go through the entire accounting cycle, and now we're going to go through some specific accounts and dive into them and look at specific issues within those accounts. So before we dive in, I would like to take a look at the accounts we will be looking at in context to other accounts by just taking a look at the trial balance really quickly. So just reviewing the trial balance, you'll notice that the debits are on the left-hand side, credits are on the right-hand side. We have the T account represented by the red T. We see that the total debits are summed up here and they equal the total credits over here. We know that the assets are on top: cash, accounts receivable, supplies, prepaid insurance, land. Here's what we're going to be focused on: land, equipment, accumulated depreciation. These are all assets. Assets generally have a debit balance, with the exception of a contra asset, which we'll be taking a look at this time, called accumulated depreciation, which has a credit balance. The credit's represented by both in the credit section as well as being a negative or bracketed numbers. In this case, we want to get used to multiple ways to represent credits because they will be represented different ways using different software. We see that the liabilities will be next, represented by the yellow, and they are also going to be credits. And then we have the capital or the owner's equity or the stockholder's equity, depending on the type of entity here, which is going to be generally a credit balance. And then we have the revenue, which is a credit balance, and all expenses, which are debit balances. If we were to take the revenue, which is a credit, minus the debits, we would come up with net income of a credit if the revenue is greater than the expenses, which we hope they are, of 86,180. And we can also see that in terms of our accounting equation: assets equal liabilities plus owner's equity. Assets being all the green numbers equals liability, which are the orange numbers, plus owner's equity. So we are going to be focusing in on this context. So it can get easy to, when we start to drill down inside and look at a particular account, not to be able to envision it within the big picture. You want to be able to kind of envision it in the big picture. We're drilling down on these accounts, looking at the specific issues related to property, plant, and equipment. But just remember that those are assets and they will rely here on the trial balance. Alright, so cost determination. First we got to think about what the cost of the equipment is. Now when we talk about property, plant, and equipment, we could be talking about building, we could be talking about land, we could be talking about equipment such as a forklift. Those are the types of things we're talking about. We can call them plant assets. Now, the reason they're going to be an asset and not expensed when we purchase it is because the definition of an asset is something that we have purchased in order to help us achieve our business objective of generating revenue sometime in the future. When we buy the asset, when we buy the building, it has not yet helped us to generate revenue, and therefore we can't expense it in accordance with the matching principle, which is an accrual principle. What we have to do is put it on as an asset and then somehow allocate that cost over its useful life, because that is when it's used in order to help us generate revenue. So the asset is something that we have in order to help us generate our goal in the future, which will be revenue generation if it's a business asset. If it's a personal asset, we might have different goals, but the same idea is there. If we have a house, we have it now in order to help us be happy now, but also achieve that goal of whatever happiness in the future. So a plant asset is going to be tangible. That means we can touch it. It's going to be something that we can feel and touch. It's tangible. It's actively used in the operation. So one thing could be either inventory or it could be an asset depending on its use. So if we sell forklifts, then it's inventory. If we use the forklift in order to move boxes around in our warehouse, then it's an asset. The expected to be benefit future periods, that's the definition of an asset. If a company has something that is not expected to be used in order to help generate revenue in the future, then the company should not have it, because the business goal, of course, is to generate revenue in the future. So the idea of having an asset is that it's going to help us generate revenue. Plant assets could also be called property, plant, and equipment. So property, plant, and equipment, fixed asset, plant assets, all are names for these long-term type of investment type assets: buildings, equipment, land. These are the things we're taking a look at. So if we're taking a look at these types of things, building, equipment, land, there's a couple things that we take into consideration. Land's going to be a little bit different. But if we talk about a building, we're going to say that we buy it when we purchase it. Once again, we purchase it. If we paid all cash, we would credit cash. We would debit an asset of building because we have not yet used it in order to generate revenue. Therefore, it's not going to be an expense. Then we need to somehow expense it over its useful life because that building does deteriorate over time as we use it in the generation of revenue. And therefore, we need to take that asset, reduce the asset, and expense it, move it from the asset basically to the expense over its useful life, over some time period. That's not the easiest thing to do because it's going to be an estimate. This is going to be an estimate for us to try to figure out, well, how long are we going to have the building and how are we going to allocate the cost of the building over its useful life. We got to come up with some estimates in order to do that. And then at some time in the future, we may dispose of the building. Now, of course, you might be thinking, well, I'm going to improve the building. I might not dispose of it if we keep it up to date. And of course, when we improve the building, we got to think about how we're going to deal with the improvements. Should we expense the improvements as maintenance, or should we include the improvements as a capital asset as well? So those are the things that we're going to have to consider as we allocate the cost of property, plant, and equipment. So the acquisition cost might seem fairly straightforward. Obviously, when we buy equipment or we buy a building, the purchase price is going to be what we enter as the cost. So if we bought it off of cash, credit cash, decreasing cash, debit the asset. If it was a building, we debit the building. But notice that there could be a lot of different things in the building as well, that we'll talk about the specifics of the building and we'll talk about the specifics of equipment, but all expenditures needed to prepare the assets for its intended use will also be included in the cost. So we'll talk about some specific examples of that. Acquisition costs exclude financing charges, so if it's a financing charge, it's not going to be included in the cost. So let's talk about that example in terms of machinery and equipment. If we buy machinery and equipment, again, of course, the purchase price would be there. That's a given. So if we bought like an industrial refrigerator, whatever the price tag was on the industrial refrigerator will be included in the cost that we include as an asset. But so will the installation, assembling, and testing, anything like that, will also be included in there because you might be thinking, well, those should be expenses, right? But those things are used in order to help us get the refrigerator, in this case, in working order. And therefore, those things have not yet really helped us to generate revenue. They helped us to put our asset in place. Therefore, they should be capitalized as the asset included in the cost of the asset that we put on our books and then depreciated over the asset's useful life. Also includes taxes on it, transportation charges. So if we had to charge for shipping, then once again, that shipping, a lot of times you might think, well, shipping, just automatically you think shipping expense for different types of shipping costs. But in this case, the shipping cost was in order to bring this piece of equipment, and therefore it should be included as part of the equipment. Same with insurance while in transit. A building. Notice that if you were going to actually construct the building, then the building could take years to basically construct. And if that was the case, notice that everything that we put into the building would generally be an asset and not an expense. It would be included in the building. If we're going to buy the building, the brokerage fees should be in the building, taxes, title fees, attorney fees, all these types of things that helped us to acquire the building should be included in the asset rather than being expensed as separate items. All right, and then land's a little bit tricky because notice that we separate, oftentimes the land comes with the building, obviously. We buy the building and we buy the land. So there's some issues sometimes because when we buy the building and the land, it doesn't always break out where the building, what cost was allocated to the building versus what cost is allocated to the land. The distinction is important though because land is considered to not depreciate over time. If we're just talking about the dirt on the ground, obviously in our human lifetime, if it's, the dirt's probably going to be there after we're gone. So therefore we basically consider the land to not deteriorate over time. And the building, on the other hand, does. So we don't depreciate land, we do depreciate the building. That could cause some problems in terms of how do we allocate the cost between the land and the building. So that's one thing to think about. The other is if we improve on the building, such as putting in a parking lot, driveways, fences, walks, shrubs, those things are improvements, and of course they do deteriorate. So those things will deteriorate, and the improvements on the land we will depreciate. The land itself, though, will not generally be depreciated. So things that should be added in the land should be things like title insurance, purchase price, of course, real estate commissions, title search, delinquent taxes, and survey fees. If those are all included in the purchase of the land, it should be in there. Some things that books like to test on land oftentimes is anything that uses to prep the land for its intended use. For example, if there's a dilapidated building on the land and we intend to tear it down and build a new building on the land, then the cost of tearing down the old building is not included in the cost of the new building. It's included in the cost of the land. And so that's one question that comes up often, which seems a little bit tricky on that. So anything that we prepare the land, if we had to tear something down in order to build something up, then that's actually included in the land, not in the new thing that we're building, such as another building. All right, and that's where we'll start